Hey, good morning, everybody, and welcome to this Tuesday, March 25th, Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you again this morning. Had a nice turn of events in the market yesterday, over the past few days, really. I think some of it can be attributed, to options expiration. Others, yesterday was a really good day with consumer discretionary stocks jumping over 3%. We'll look at those various sectors in just a couple of minutes, but that was a real positive coming out of yesterday. Some of it was gap, so we want to kind of see a little bit more in terms of intraday movement in consumer discretionary versus staples, but definitely better than the alternative of seeing more weakness in the market. We saw some key indices move back through 20-day moving averages, others testing the 20-day moving average. That's usually a pretty big level to try to get through when you're downtrending. So if you can get through the 20-day moving average, to me, it starts to look a little bit less likely that we're going to have another big drop to the downside. Of course, sometimes you get those head fakes, you get up above the 20-day for one day and then, have another swoosh to the downside. So we need to continue to evaluate how the market performs the rest of this week. But I definitely feel a lot better about the market today than I did even just a few days ago. So we'll see how the market continues to perform. I had doubts that we'd get through the 20-day moving average. We still have some key overhead resistance levels that we need to get through as well. So it's not just the 20-day. We want to make sure we get through some of these other key resistance levels. So we're definitely not out of the woods. I wouldn't say that. But for anyone who recently, because it was probably about a week ago or maybe even a little more than a week ago, I thought maybe we were getting close to a reversal. I'd sent out email, I think it was a daily market report to our members. I don't remember if it was on a week ago Thursday, but I believe it was a week ago Thursday, just talking about the some of the signs that short term, we could be seeing a little bit of pushback to the upside. I certainly wouldn't be surprised, especially with options expiring and so forth. So overall, I'm pretty pleased. Have to say, pretty pleased with the movement yesterday and being able to get back above key moving averages. I think that's at least a start to repair a lot of the technical damage that we've seen in the first quarter of 2024 or 2025. And if you recall back in January, this is what I looked for. I looked for a correction. I thought we could get a 10% drop in the first quarter. I thought the first quarter would be very challenging. We've seen that. There's a lot of uncertainty. Some of that uncertainty still out there. Sometimes the market, though, will start to trade as if that uncertainty is not there, like it's almost a certainty. What maybe the Fed's going to do going forward and so forth. And until or when they are maybe let down, the market continues to move up until that happens. So a lot of different possibilities here. And I don't want to sound like I'm waffling, but it really is hard to predict the market from day to day or even week to week. I think from a longer term perspective, it's a lot easier. At least it has been for us for the last several years. I think we've got a pretty good track record there. And I do think longer term, we're fine. I've said that all along. I don't think this is anything that's going to drag out, that's going to morph into a bear market. Certainly not a secular bear market. Cyclical. There have been some signs recently, especially that big down day on the consumer discretionary recently. Remember, I talked about that confirming a market top. I think that was back on like February 22nd, February 23rd, something like that. But that was the day we had the big move down in consumer discretionary. At the same time, big move up in staples. It doesn't happen very often. And usually when it does, it's part of a bearish scenario, whether it's a correction or a bear market. And so now we do have a correction in our back pocket. I mean, we've seen it. S&P did go down more than 10% at its low. And so I think the market now, I'm trying to evaluate just to see whether or not this is it. Or, I'd like to actually see one more test at least of a low to have a double bottom, maybe even a move slightly below and then come back up with a kick save. I'd feel a little bit better about calling that as a bottom than right now. Still, like I said, we still got some work to do here. So anyhow, let's take a look at what's going on or what happened in the market yesterday. You can see, first of all, a lot of green. The other thing down here at the bottom is really important. That volatility index is getting down to a level where it's not quite there, but it's starting to tell me that the worst is behind us. I mean, remember the VIX a week ago was up at 30. Now we're back down at 17. We've only really had one, what I would say, really good day, and that was yesterday, where we gapped up and continued buying throughout the day. I thought that was a really good day. But historically, if you are going down and you're bouncing and you're wondering if you're in a bear market or maybe getting out of a bear market, the VIX has been one of the best signs historically. When that VIX drops back down, if the VIX drops back down below 16, we have never, well, I don't know if I want to say never, but I don't think that we've ever seen a bear market develop from that previous high. So in other words, if we think we're in the midst of a bear market and that VIX goes down below 16, we've never had in our history that I can recall that same move to the downside morph into a bear market. So one of the things that a bear market you need is high volatility. You need that fear. You need that panic. And when the VIX gets down below 16, it's a sign that that environment, it's all, it's like saying, well, we got a 30% chance of tornadoes. And you see these nasty clouds rolling in, the wind's picking up, and you're like, yeah, maybe we are going to get a tornado. And then the clouds go by and the sun comes back out. And you're like, well, I don't think we're going to have a tornado now. It looks like everything's kind of cleared back up again. That's kind of what the VIX tells us, that as long as that VIX remains elevated, there's a chance that we're going to get that next swoosh to the downside. When that VIX comes back down below 16, in the past, what has happened is we don't see a bear market until we've gone back up to another new high. So, and it's something else. It's not part of the current weakness. So I don't know really how else to explain it except that weather analogy. It's like things are clearing up when the VIX gets down. I mean, even to 17 is good. But if we get down below 16, historically, that tells us that the worst is likely behind us. So anyhow, something to keep an eye on. I like to watch the VIX. The VIX, by the way, is priced essentially by market makers, because market makers decide what the premiums are on options. And it's the short-term S&P options that value. I mean, that's where the VIX valuation comes from. That's the expected volatility based on the option premiums that are set by market makers. So I like the VIX because it's giving me a sign of what market makers are expecting as opposed to what individual traders are expecting. That's the 5-day moving average of the equity only put call ratio. I like to follow both. And the reason I like to follow both is because they're coming from two different angles. Anyhow, Dow Jones up 600 points yesterday, back to 42,583. Remember, 45,000 was the number where we set the all-time high. We dropped back down more than 10%, or close to 10%. I'm not sure if the Dow ever hit the 10% level. I'd have to go back and look at that. But we bounced back nicely, 600 points again yesterday. Really solid action there, 1.4%. S&P up 1.75%, 100 points. Remember, I was looking at that 56.75 area up to about 57.82 in that range. And I'll show you that chart in just a minute. We made up almost the entire resistance area yesterday, got to 57.67, getting very close to that 57.82 level. And last time I looked, and let me give you those numbers, futures were up, not a lot, but they were up a little bit. Let me see diamonds right now. And we've got 22 minutes to the market opens. Diamonds right now are up 0.25%. The spider up about 0.3%. So 0.3% would be 16, 17 points. That's going, I mean, if we open where we are right now, what futures are telling us, at the S&P is going to open right around that 57.82 level, or maybe more, higher if futures continue to rise. QQQ right now, pre-market up 0.25%. And the IWM was lagging, and it is still lagging, down about 0.2%. But overall, futures are higher this morning. It looks like the S&P could be moving up to test what I think is a pretty key resistance level right around 57.82. And I'll go over that number and show you where that number comes from in just a minute. NASDAQ up 2.25% yesterday, over 400 points. Pretty impressive there. Coming down to the small caps, up 2.57, almost 2.6%. The mid caps up 2.5%. And then you go down the NASDAQ 100, which was down not quite as much as the NASDAQ, or excuse me, not up as much as the NASDAQ, up 2.16%, still getting back up above the 20,000 level. So overall, really good day yesterday. Again, this is kind of what Max Payne was pointing us to a week ago. Very interesting. I think the Max Payne on the QQQ, which tracks the NASDAQ 100, a week ago Friday, when we sent out our report to members, we were showing the QQQ with a Max Payne level of 489.47. I think we closed like 490 or 491 yesterday. So, and that was from a level of 479. Now, we're not trying, when we do our Max Payne, it's always the Tuesday before the third Friday. Third Friday is always when monthly options expire. So we always look at Max Payne the Tuesday before. That's our meeting, or our event for our members. But the Friday before is when we send out a report to members saying, okay, here are all the major indices. This is what it's looking like right now. Here are all the Dow stocks, the NASDAQ 100 stocks, and all of our portfolio stocks in terms of where their individual Max Payne levels are, so that our members can at least have that side of the equation. I mean, have that knowledge of what could be in the best interest of market makers to start moving stocks toward their Max Payne levels. Now, talking about Max Payne, I did see a question that came in, and I don't know if it was a sarcastic or whether it was actually just a real question or a statement being made, but there was a comment that came in and said something about the takeaway for me was that Max Payne wasn't working because the market was going up. And we always talk about the market generally coming down with Max Payne, but that's because the stock market is going up heading into Max Payne week. So there's going to be a lot more in the money calls, which is why it would make sense for market makers to want to bring prices down. But that's not what we saw in the market this month. Market wasn't going up. Market was going down. It was going straight down. So there, what we had is a lot of in the money puts in play, more so than in the money calls. And so it actually behooved market makers to have prices move back up. They could save a lot of money, millions, even billions. And so, when I say billions, I'm talking about all across all ETFs, all individual stocks. There's a lot of money at stake around options expiration Friday, monthly options expiration Friday. So you need to be aware of that data as you go into this week. But anyway, that's the reason why we were looking for the market to bounce. So it's always the opposite. I always call it opposite George week, Seinfeld reference. And if you're not familiar with the reference, it was a really great episode. George Costanza, never getting anything right in his life, talking, always whining and complaining and everything. And so I think it was Jerry who said, well, if everything in if every decision you make in your life is wrong, then start doing the opposite. And so he starts doing the opposite and things start working out a lot better for him. But anyway, that's the reference to me, because whatever's not working going into options expiration week magically starts to work. And so, or things that are working going into option expiration week all of a sudden stop working. And so I always call it opposite George week. But anyhow, and so we got some of that. We always look at it as a directional move. I'm not trying to paint a picture that, hey, this stock, yeah, it's at 250 today, but in 3 days it's going to be 330. That's crazy. No, I wish it worked like that. But in that scenario, if a stock is trading at 250 and its Max Payne level is 330, what we talk about is Max Payne is giving us a directional clue that the price of the stock is going to go higher. It's going to help save them some money, market makers some money, if prices start to gravitate towards that. And that's what we're seeing in the market right now, is exactly what we talked about a week ago. We're seeing this bounce. I mean, the market was oversold. We said it was in the best interest of market makers to see the market move back to the upside. And so now magically here we are 4 or 5 days later, almost a week now removed from last Tuesday's event, and prices have gone exactly as we talked about. So that's why I'm a little, I want to see some more movement to the upside. I want to see some key resistance levels being taken out, because this could be nothing more than just a Max Payne related, options related bounce, oversold bounce, and another leg to the downside. But again, I'm encouraged by the fact that when we look at the sector summary, you can see discretionary up 3.75% yesterday. It was a big move. Anytime any sector goes up almost 4% in a day, that's a pretty nice move. And so that's what we saw there. Look at Staples. Staples only up less than 0.2%. So there was a big, more than 3% gap in discretionary versus Staples. For the past month or two, we've been seeing the exact opposite. We've been seeing discretionary relative to Staples going down, and both groups going down. Yesterday, maybe you want to blame it on opposite George, I don't know. But yesterday we saw the opposite. We saw discretionary moving up well above Staples, which also moved up. So both consumer both consumer groups moving back to the upside. So I think the action for the last few days has been encouraging. I don't think it gets us totally out of the woods. But I do think the further we get removed from that recent bottom with earnings season coming up, I think the less likely it is that we go back down. But anyway, we'll talk a lot more about that later this week, and I'll talk about that later in the show here. S&P 500. So here was the move back above that 20-day moving average. So the key here is that normally when you're trending up, you come down, you test the 20-day moving average, and you go back to new highs. When you're trending down, normally your bounce goes back to the 20-day moving average and fails. When this whole thing started back from February 19th high, that was the closing high, you can see when we went down through the moving averages, when we came back up, we failed right at the 20-day moving average and then saw a swift drop from there. For the prior 2 months to this high, or maybe even 3 months, we had what I call trendless action, because we have a history of going back down below moving averages, back above, back down below, back above, and so forth. We did this multiple times over a 3-month period. And that just tells me we don't really have a trend in play. If your 20-day moving average is not holding, it becomes worthless to trade off of because you're not trending. And so here, this was a sign that we are absolutely trending to the downside. This move back up above it tells us, well, maybe it's over. Maybe if we continue to stay above the 20-day, maybe we just see a little sideways consolidation and then back up. Maybe this is a V bottom. I just wrote an article. I wrote our weekly market report for members, and I said I don't think it's a V bottom. It could be. I don't think it is, just because of some of the other signals that we've seen on the way down. But you never know for sure. Again, short term, really difficult to call the market correctly all the time. I mean, you'll stress yourself out. That's really difficult to do. But if you can get the overall general trend in play, then it allows you to play these moves to the downside with a bit more confidence on the long side when you do get oversold, or when you start to see positive divergences emerge, even if it's only on like a 60-minute chart. But anyhow, that was a nice move. It wasn't just a gap up. It was a gap up and buying throughout the day, which was nice. Now let's go back. Let's pull up some others. Let's look at the NASDAQ 100, and we see basically same thing. Gap up beneath the 20-day, but we saw buying throughout, went through. Now we're looking at futures that are gapping up. The one thing that would be a big, worrisome signal would be as if we gap up and then sell off and put in a bearish engulfing candle today, where we go back down, fully engulf yesterday's candle, and we're back down below the 20-day moving average. That would be something that would be certainly less than ideal. Let's see. Let's go back. I wanted to show you one other thing on that S&P 500 chart, if I could. So I'm going to annotate this and show you where I got 5782 from. So this close right before the election results came out was at 5782. And then the election results came out. We had the gap up, went to, closed up probably, or opened up maybe close to 100 points, 80 points, whatever it was. And we've never gone back down below that 5782 level. That was our gap support. Now, on January 13th, and I talked about this over the weekend in my weekly market recap video. Check that out if you haven't already. But I talked about January 13th being kind of a weird day when a lot of things changed. That's when the uptrend ended on the US dollar. The dollar went down. That's when a lot of the foreign um, uh, markets, foreign stock markets, started to outperform in a meaningful way versus US. I don't remember if there was any catalyst on January 13th. I don't remember what happened that particular day. I just know I'm seeing it on the charts. So this day we gapped down coming off of a downtrend. We gapped down to exactly 57.82. Same as this level over here, this gap support. And we saw buying right off of it. So all of a sudden, 57.82 becomes a really big level because it's not only now a gap support, but it's become exactly the price support. And if you notice, when we came back down early March, we put in a tail below 57.82, but we came back up and held it. I think we may have closed just a tad below. For some reason, I'm thinking 57.78. But anyway, the next day we went right back up above and it looked like, oh, here we go again, back to the upside. Not so fast. Then came more selling. Also, just prior to this, I think it was right here on February 23rd, or no, February 21st, Friday the 21st. This big red candle that you see right here, that was the day that we saw discretionary selling off all day long and staples going up all day long. Massive distribution, massive rotation from aggressive discretionary stocks to defensive staple stocks. And that had only happened to that degree 9 other times since the financial crisis. And each of those 9 times previously, we were either in a correction or a bear market. Bear market, cyclical bear market, 8 of the 9 times. One time it was a correction. So this did evolve from there into a correction. So that streak is still alive. Does it become a bear market? Is it a correction? We don't know the answer to that just yet. But anyway, 57.82, that's why I'm kind of watching this 57.82 level, because we went back through a key support level. That was a pretty big support level in the near term. Went through it. And so you come back up. What happens to broken support? It becomes resistance until you can get through. That's TA 101. So 57.82 is a number I'm watching closely. Not so much on the open. I think we, like I said, we might open at that number, maybe even slightly above it. But do we put in a bearish engulfing candle and come back down and fail? That would not be a good look on this chart. Would probably add to the possibilities of at least a double bottom and maybe an A, B, C kind of a move back to the downside where we do still potentially put in a lower low. How low? Now, I'll be talking about that on Saturday, and I'll show you that in just a minute. But that's why on the S&P 500 right now, I'm watching that 57.82 level. So let's talk about the transports. Transport's still under a lot of pressure. We did see some, first of all, we saw a huge rally. Look at this lower low. And I mean, if there's one thing I could teach you about candlesticks, just in my experience, when you're going down, you bounce, you go down, you bounce, you go down, and then finally get to a level, a key level like this, where you go down, it looks like you're breaking to another new low, and then all of a sudden you're not, and you have a big reversal off of a downtrend, and you had a false breakdown. That, and especially with the volume, now it was quad witching day, which always carries more volume. So I would maybe not put as much stock in the volume for that day, because we always tend to have a big volume day on. It's March, June, September, and December. Those are the 3 months where you have quad witching. And so if you look back, here was September's, June. Of course, this is the transportation index. I could show it to you on the S&P 500. I think it would be more meaningful. But anyway, transport's made a nice recovery, false breakdown, and now we've got to move back up potentially to test the 20-day moving average and see if we can get through. But if I go back to the S&P, so here's the volume in March. Here's December's volume. This is quad witching. September, quad witching. June, quad witching. The 4 biggest volume days of the year are quad witching option expiration days. So it's just a lot of different contracts, options, and so forth that are all expiring simultaneously. And so you got a lot of traders out there that are, getting out of some positions, reestablishing other positions. And so there's a lot of volume associated with all of that. So if you see something you think on the chart and you're like, wow, look at this move. This is really a big move. And oh, by the way, volume is awesome. Well, if it's the third Friday of March, June, September, December, maybe would temper that enthusiasm just a bit because we always get big volume on those days. All right. Let's talk just for a minute about this upcoming event because I think this is one's going to be huge. You know, trying to get the market correct isn't easy. I think we have a pretty good track record of trying to look out from a longer term perspective. I like to call big picture, coming up with where we think the market is going. It's especially important for anybody long term, whether to get out of your positions or just hold on for the ride, because those who are buy and hold want to hold on for the ride. They don't want to trade. And I get it. There's a lot of folks don't want to look at the market every day. They just want to know, are we going to go higher? Or should I really be worried about whether or not we're going to take a big hit? I said at the beginning of this, I don't think this is going to be a big hit. It could morph into that. And I think with this latest move down and now this rally, I think this is kind of the critical time frame on whether we're going to end with a correction, which is anywhere from 10 to 20%, or if we're going to end with something much deeper. So on Saturday of this week, just in 5 days, 4 days, no, 5 days, no, 4 days, 4 days from now, right about, we'll be starting at 10 a.m. on Saturday morning. But we're going to take a preview, a look of next quarter and kind of some of the things that are setting up and whether you should be thinking bear market or correction. I'm going to give you a lot of things to think about, but that'll be on Saturday morning and it is free. You have to register though. So go to our homepage, earningsbeats.com. And by the way, even if you can't make the event live, we'll make sure you get a copy, but you have to be registered. So even if you got plans on Saturday, don't think, oh, I can't make it. Oh, that's a shame. Register. We'll send you a recording. So anyway, it is a free event. You click on that. Very simple. Name, email address, submit. No credit card, completely free. I just want to kind of, again, give back like we do a lot at Earnings Beats, kind of help you deal with the market. Again, I think our track record with calling the market has been outstanding. I mean, I don't just say that. We have recordings of our last 5 Market Vision events, actually 6, 20, 21, 22, 23, 24, 25, 6 of them, and been pretty spot on. I mean, just 2.5 months ago, I said the first quarter would be challenging. I think everybody can acknowledge at this point it's been pretty challenging. Said we were ripe for a possible 10% correction. S&P down 10%, NASDAQ down 13%, IWM, which tracks the Russell 2000 small cap index, down 17%. We've seen it. So where do we go from here? Check it out on Saturday. Name, email address. That's all we're asking for. Sign up, and the seating is limited. So we need to have a pretty good count to make sure everybody can get in. So make sure that you register for the event. I would register sooner rather than later. All right. Let's just wrap up here. I wanted to talk about, first of all, the max pain, just for a minute. We talked about that a little bit earlier. The QQQ in our report a week ago Friday, we had the max pain listed on the QQQ at 489 from the price at that time of 479. So we were looking for the possibility, a directional move in that direction with the actual max pain coming in at 489.47. We closed yesterday on the QQQ at 490.66. Not bad. The top stock that we listed, the one that had the most in the money put premium, the one stock that looked like it had the best chance to move higher as of a week ago Friday, was Meta. Meta, we talked about going up, well, being it would save market makers, or at least it was underwater, the net put premium. So it's the put premium minus the call premium on Meta was $153 million. And the max pain price was $626.49. Now, we finished Friday with a little bit of a move back to the upside, getting close to 600. Yesterday, up to 619. I think this morning, I think I saw Meta was up a few dollars. Well, market, I guess, just opened. Yeah, it did just open. It's up $8. It's at 627. So 627, and a week ago Friday, we gave the number at 626.49. Now you might say, well, wait a minute, it's Tuesday. This is after options expire. But what we explained to our members is that the impact, the effect of max pain can last into the following week because folks who have options can exercise those options. So if you've got put options and you exercise them, you are shorting the stock, which means the market makers are doing what? They're on the opposite side of the trade. They're going long. You short, they still have financial incentive to take that price higher, so for the first couple of days of the following week, I still think there's a lingering effect or can be a lingering effect of max pain. So as far as I'm concerned, the call that we had with the QQQ, with Meta, I mean, these were really, really good calls. Our members get that every month. Just saying. It can make massive improvements and make massive difference in your trading. Last thing I'll do here before we wrap up, let's just see what's going on this morning let's do our strong earnings chart list, and we'll do a little view all just to see what some of the leaders are today. So right now, Cloudflare, this is actually one of our portfolio stocks. This is awesome. Up 6.42% already this morning, just in the first couple minutes. Let's see, coming down the list, actually, let's put in here the sector and industry. Maybe we can let's look at software and see if it's kind of a software thing. A lot of software doing pretty well. That's Cloudflare leading the pack. Then we got CXM, CrowdStrike. That's good. Apps. That's actually that's in our aggressive portfolio. Come roaring back. Got down to, I don't know, 250, somewhere around $2.50, back up to 373. It's made a big move. Now, let's see, 5.9, Unity Software Team, and so forth. Anyway, it does look like software is off to a pretty good start. I can also pull up some of the semiconductor stocks. Now, if you don't see the stock, let's say you have semiconductors, you own some, and you don't see them on our list, they may not have beaten earnings in their last quarter. You have to beat earnings, your bottom line. You also have to beat revenue estimates in order to even be considered to go onto this list. So if you're looking at a company, you may have a software company that's up 10% today, and you're like, why isn't it on that list where you showed all your software stocks? It's because it maybe didn't beat its revenue and earnings estimates. Or if it did, maybe it's not liquid, or maybe it's not doesn't have a good technical chart, because that's the other thing. We do look to try to make sure that it looks promising from a technical perspective. So there are reasons why a stock wouldn't be on one of our chart lists. But anyway, I just wanted to point that out. So here's semiconductors. Now I see one stock on two doing pretty well. Not a lot else though. And you can see there are a lot of semiconductor stocks out there. Not many made our list, partly because many of them came up short on their estimates, and others just were falling apart technically. So they didn't get added to our strong earnings chart list. That could change if we see an improving semiconductor group as we head into Q1 earnings, which will start middle part of April. What else? How about internet? See what internet stocks are doing. There's Meta up 1.42%. Netflix having another nice day today. EverQuote, this stock has just been on fire. It is in all-time or 52-week high territory. I'm not sure if that's all-time or not. No, it's not all-time, but it is making a pretty significant breakout here that could potentially lead to a test of that 65 level that we saw back in 2020. Anyhow, this is how you can just quickly at the start of the day take a look at some of our chart list. We could maybe pull up raise guidance. These are companies that have raised guidance. in the last 3 months. Let's pull up the view all, see if some of those are making a big move. Let's see, 7% move up on SEZL. That's a financial administration stock. And I'm kind of looking at sectors and industries as we go. Few technology. There's one discretionary, Lulu. They report later this week, so be careful there. They report on Thursday after the close. Stock is up 10. Let's take a look at Lulu. Let's wrap up with this one today. It's back up above its 20-day moving average. Maybe it makes a run for its 50-day moving average prior to earnings, and then we shall see what happens. You can see the AD line not particularly strong relative to clothing and accessories. It's kind of been up and down over the last year, but mostly trending lower. So I've got some reservations here as we go into earnings. It looks like maybe volume trends aren't that great, but I will say this: weakness is probably not a bad time to think about getting in to Lululemon, because look, this is the 25 or 20 year, almost 20 years monthly chart on Lululemon since they went public back in 2007. And you can see they got a pretty good long-term track record. So it's kind of hard to bet against the stock. Obviously, they've got some really great products that are used quite a bit by the masses. And so this is a company that has outperformed. I mean, if you look at clothing and accessories generally, most of the stocks just go up and down. They get hot for a while and then they just go right back down. They're not great long-term holds. Lulu's been one of those that has been a pretty good long-term hold, although it has been sideways consolidating for the last 5 years. Needs something to kind of jumpstart it to get to another new high. But if it does come down with earnings and it's down close to the recent support, that might be something to consider. Just kind of play it by ear there. Anyhow, let's take a quick look at the market, where we are. We got the Dow up 31, S&P up 1, NASDAQ 5. Small caps down just barely. So I don't know. We've kind of gone, up a little bit, now kind of pulling back, it seems. Let's just look at that QQQ intraday chart. Yeah, I mean, it was up early. Now it's back down, but still the uptrend from yesterday in play. We may bounce off of, a test of gap support and then move back to the upside. Spider still hanging in there pretty well. IWM was down at the open, but it's actually above its open and did go up and put in a new high earlier, right after the open. So my guess is we probably continue that move to the upside. I give it more than the 50% chance. And then we just see where we are end of the day. But anyhow, that's it. That's what I've got for today. So let's watch it and see what happens. Keep an eye on the VIX. Let's see what that VIX is doing this morning. It's back down now to 17, hit a low of 1709. Right now it's 1724. If that continues to drift lower like it has over the past week, that's going to be a really good sign for the bulls. Anyway, have a great rest of your day, everybody. Happy trading.